All right, so on the ET Money Show, we make sure that we don't just talk about investing in mutual funds, but also help you meet the brain behind these funds. And in this week's Meet Your Fund Manager segment, we have with us Lalit Kumar, which has been managing ICICI Prudential Commodities Fund since July 2020. Lalit also handles other funds in his portfolio. Lalit, good evening and welcome to the show. And today we are going to talk about your commodities fund. So that's something new for our viewers also. So before I begin, I just want to understand what do you actually mean by a commodities fund?
Good evening and thanks for having me on this show. So in commodities fund, basically we invest in commodities across sectors. Say for example, metals and mining. In metals and mining, we can have exposure to steel, we can have exposure to aluminum value chain, copper and other commodities. Similarly, we can invest in sectors like cement, we can invest in specialty chemical, agrochemical. We can also invest outside 80% in oil and gas. So these are the sectors where we can invest in, and these are the main buckets where we focus on.
What will be the current composition of your portfolio, if you could just share that in terms of sectors allocation?
So currently in the portfolio, we will be overweight on cement and metals. So these two will contribute, say, roughly 40% and 30% each. And then we have exposure to oil and gas and agrochemical, which is something like 15% each.
All right, so the first two remain cement and metal. Now, talking about thematic funds. Now, thematic funds make money when sectors that you've put in money really do well. But the real success, Lalit, comes when the fund manager identifies the right phase of this cycle. Now, this sector being very cyclical, explain us what are the bets that you've put in the fund. What is the rationale behind it? Because a lot depends on global factors and also on domestic grounds for you.
So this I think is very important question that you have asked, and this fund is very different from some other funds because here we can play multiple sectors, multiple commodities, and we can also play upcycle and downcycle in a commodities. Say for example, if one is positive on oil, one can buy upstream. One is negative on oil, one can buy OMCs. If one is positive on say thermal coal as a commodity, one can buy non-ferrous name. If one is negative on thermal coal, one can buy cement. So this is the beauty of this fund which separates this commodity fund from others, where we can play both upcycle in a commodity and downcycle too. And similarly, different sectors have got their own cycle. Say for example, cycle is to a large extent global, driven by what happens in China and other economies. Cement sector to a large extent is driven by local factors. So while we can play different sectors, but different sectors may or may not be correlated with each other. And that is where, based on cycle, we identify which are the sectors which are at the bottom of the cycle we buy. Say, for example, in CY 20 and 21, if you see, we bought metals in a big way and made money. Then in CY 22, we shifted that money to cement. And that is where, we were able to protect capital and make returns too. So depending upon where we are in a cycle, we will switch from one sector to other and try to generate returns.
Exactly. So let's talk about metals, because the kind of bet you've put on it, they have really helped you outperform as well. Now going ahead, and also explain me the China scenario now going ahead, how is it going to pan out for you for this particular fund and metals in general?
So in metals particularly, we are betting more on steel cycle. So if you see currently, say for example, last quarter numbers, if you see as a pack, most of the companies, whether it is in India or China, steel companies, they were reporting loss, or they were reporting at their lowest EBITDA per ton. Some of the companies in China, they have reported loss in the last quarter too. And this is all driven by two factors. One is in last 1 year, we have seen China being in a lockdown phase, and that is because of zero COVID policy. So which impacted demand. And second is because of Ukraine issue, we saw raw material prices going up. Say for example, coking coal something like $600 per ton. So in a macro environment when demand is weak and your raw material prices are going up, it's very difficult for these companies to pass on. And that is where we saw profitability for steel companies actually collapse. And I think current level of EBITDA per ton for these steel companies, whether it is in India or globally, is not sustainable. these kind of profitability should turn around. And that's why at the bottom of EBITDA per ton, it makes sense to look at these sectors.
All right. I also want to understand the currency play in this particular composition that you've made.
So in steel, of course, dollar is important. Particularly historically, what we have seen is fall in dollar is positive for commodities. So as in last 1 year, we have seen dollar appreciating, which was another reason why there was pressure on commodities. As dollar depreciates, that should be positive for metals and mining sector.
So clearly this sector is, high returns and high risk, sort of a bet for an investor. But talking about last 10 years performance, Lalit, we have seen that Nifty Commodity Index has actually outperformed the broader indices 3 out of 10 times. Now, if you talk about the story of 2023, what is it that's there in your mind? Because in last 1 year, the kind of composition you have, it definitely involves high risk, but you have helped investors make money. Going ahead, how do you think the trajectory?
Yeah. So first on risk part, our investment style is counter-cyclical. So when we buy stocks at the bottom, and the counter-cyclical investing by its nature, minimizes risk and maximizes return. And that has been the style in our fund. Second, as far as outlook for 2023 is concerned, I think from here on, we are negative on energy. So that's why I think, say, for example, cement as a sector, with given, say, for example, thermal coal prices. Thermal coal prices at some point in time reached $400. Now that has already corrected to around $200. Still, it's pretty high compared to its mid-cycle. So as the thermal coal prices correct, we expect cement sector to do well. And so we are betting on cement companies. Also from a structural perspective, say cement companies, if you look at their ROE based on their greenfield capex, ROE is still lower than cost of capital. So this industry will see cyclical upturn, and there is also a structural angle why these companies should see a structural improvement in their EBITDA per ton, at least to a stage where they can make decent return on the capital. And that's why cement is a sector where I think 2023 should be good. And similarly, steel, which is a play on recovery in EBITDA per ton, China as a economy will open up, which should be positive for the demand cycle. So we think for 2023 should be positive for cement and metals, and that is where we are putting our money in.
So I can see the allocation, which is already high in these two sectors, going ahead further. Now, please explain us the kind of placement an investor should have in their portfolio for this commodities fund.
So I think given that this fund has both risk and reward, and we have tried to maximize return and minimize risk by counter-cyclical investing, so one should look to do SIP in the fund, and maybe 10 to 15% of allocation, equity allocation to these funds should be good.
Any other new additions in the new year that you would think that could benefit the fund? Talking about precious metals, what is your take on it, and do we see it coming in your fund?
So at this point in time, whatever investment we have done, that is in Indian equities, and in Indian market, we don't have any precious metal miner as a company or stock to invest in. So at this point in time, there is no such plan.
Right. Explain me one thing. Do you have a high exposure in small cap?
So small cap currently will be around 14 to 15%. So we play small cap, mid cap, and large cap depending upon where we are in cycle. So for example, in 2020, markets were very cheap, and that was the time when we increased exposure to small cap. As markets move up, we actually cut down exposure to small cap and shift that allocation to large cap. So currently exposure towards large and mid cap names are pretty high compared to small cap.
All right. Now, talking about, you've already explained us the global scenario when it comes to metals, but then talking about fears of recession, economic slowdown, and the kind of demand one is witnessing. There are supply constraints. Do you really feel that a slightly higher exposure in this fund can be a good bet in terms of diversification? The minimum amount could be 5 to 10%, but then if someone wants to really go higher, looking at the kind of scenarios which are building right now, is there a limited downside if we go a little higher on the exposure in the portfolio for this fund?
So while I understand that globally things are pretty bad, and that is the reason why these stocks are trading at such a weak EBITDA per ton or at the bottom of the cycle, allocation will of course depend upon risk appetite and for the investors, and it will vary upon what kind of risk appetite investors have. But one has to keep in mind risk reward both when investing in any fund, and that applies to commodity fund too.
All right. Lalit, thank you so much for being on the show and explaining all the nitty-gritties related to the commodity fund that you're handling. Thank you so much.
Thank you so much.
With that, we'll take a short break. After that, we'll be joined by Feroz Aziz, who's going to help our viewers plan their financial goals.